Gift funds for a mortgage are completely legal, and yet they still kill or seriously delay deals. I've watched parents wire $15,000 to help their kids buy their first home, and 3 days before closing, the underwriter suspends the file. Everyone's frustrated. The buyer thinks the lender's being difficult, and the parents are offended, and the realtor's panicking. But the problem isn't the gift, it's the paper trail. And once you understand how underwriters actually think about gift funds, not emotionally, not relationally, but mechanically, you'll understand why these issues happen and how to avoid them completely. Today, I'm going to walk you through the 3 underwriting tests every gift fund must pass. It doesn't matter if you're an FHA, conventional VA, or USDA borrower. The logic is the same. The documentation only shifts slightly, but the core risk framework never changes. And if you understand the framework, you stop reacting and you start planning. Now, before we go any further, a quick note. I've closed thousands of loans over 36 years in mortgage banking, but I'm not your lender. Guidelines evolve. Lenders can add overlays, which are additional rules above and beyond what the agencies require. So always confirm documentation requirements with your loan officer before any funds move. Now let's talk about how underwriting really views gift funds. When large sums of money enter a transaction, the underwriter is thinking about 3 things. Is the money real? Is it documented? And is anyone expecting repayment? They're not evaluating family generosity. They're evaluating risk, because if a gift is secretly a loan, then your debt ratio is wrong. If the funds came out of an unknown source, that's a compliance problem. If the transfer can't be traced, that's a fraud risk. So every gift fund must pass 3 tests. First, is the donor eligible? That sounds basic, but it's where mistakes start. Most programs allow immediate family members. Some allow employers. Some allow charitable organizations. VA can even allow non-family in certain cases. But the universal red line is this: the donor cannot be someone who benefits from the transaction. The seller cannot give a gift. The builder cannot gift you money. And the real estate agent can't gift you money, because then it's not a gift, it's a concession. And concessions are limited differently and calculated differently. That's why eligibility matters. It changes the classification of the funds. Second, is there absolutely no expectation of repayment? This is where the gift letter comes in. And the gift letter isn't just a formality, it's a risk statement. It must clearly state the donor's name, relationship, and the exact dollar amount, and that no repayment is expected or implied, and that the funds are not a loan. And here's what people don't think about. Informal promises count. If mom says, well, just pay me back someday, that's technically an undisclosed debt. Underwriting doesn't evaluate intent, they evaluate obligation. And undisclosed obligations distort debt to income ratios. That's why the wording matters. Third, can the transfer be traced? This is the one that creates the most delays. Underwriting must see the money move from the donor to the borrower, or donor directly to the closing agent, escrow, title company, attorney, whatever. They need to see that donor had the funds, and that the funds left their account, and that they landed where they were supposed to land. A line item on the closing disclosure that says gift funds is not proof. That's accounting. And underwriters don't approve accounting entries. They approve documented asset flow. And here's a rule that has never failed me in 36 years. Documentation beats common sense every time. Now let's apply this to different loan types, because this is where the nuance matters. With FHA, gift funds are widely accepted. Family members, employers, close friends with documented relationships, charitable organizations are fine. But FHA is very clear about one thing: no cash on hand. If someone hands you $8,000 in physical cash and you deposit it, Underwriting now has to source physical currency. Where did it come from? Was it withdrawn? Was it saved? Was it mattress money? Cash is inherently harder to document, and FHA does not like ambiguity. So FHA requires gift letter and evidence of transfer. That can be donor's bank statement showing the withdrawal paired with the borrower's deposit. It can be a copy of the donor's gift check and the borrower's deposit slip. It can be a wire confirmation and a copy of the donor's bank account showing the money in the account. But the key is always the visible trail. Conventional Fannie Mae and Freddie Mac loans allow gift funds on primary residences and second homes, but not investment properties. The same three tests apply. But here's the wrinkle that surprises people. Large deposits. If you deposit an amount that is large relative to your income, often anything over 1/2 of your monthly qualifying income, and you plan to use it, underwriting will require documentation on that source. If you cannot document it, they don't argue about it. They simply exclude it from usable assets. That means the money doesn't exist to the lender. That matters if you're relying on those funds for reserves or for closing. And now on to Venmo and Zelle. Electronic apps can be used, that's fine, but the documentation standards, they don't change. Underwriting must see the donor's bank account showing the funds leaving, and they must see the confirmation of the transfer and entering the borrower's account, showing receipt. If the chain breaks anywhere, even if the money is legitimate, you'll get a condition on the loan, and conditions slow down closings. If you're a realtor or a loan officer watching this, send this section to your client before they hit the send on a Zelle transfer. One proactive conversation can save an entire closing timeline and a lot of heartburn. VA loans often don't require a down payment, but gift funds are commonly used for closing costs. VA allows gifts even in some cases if it's a non-family member. And again, as long as the donor is not involved in the transaction, then it's fine. The documentation expectation is still the same. Gift letters and proof of receipt. Some lenders may request the donor's bank documentation, even though the VA handbook language isn't as detailed as conventional. And that's because lenders manage risk beyond the handbook minimums, which is why overlays matter. Always confirm before funds move. USDA is stricter. Funds must be traceable. USDA also scrutinizes non-payroll deposits carefully. If gift funds are mixed into an account with multiple unexplained deposits, expect detailed questions. So keep it clean and keep it isolated when possible. Simplicity speeds the approval. The 4 paper trail mistakes I see constantly is first, commingling. Depositing the gift fund into your account at the same time as payroll or other deposits makes it harder to isolate the gift funds. Keep gift funds completely separate. Second, donors who can't provide documentation. Some donors are uncomfortable sharing bank statements or only share partial pages. That's incomplete documentation, and incomplete documentation only causes delays. Third, relying solely on a closing disclosure as proof of transfer. That's insufficient. The lender needs to see the source account and the receiving account. Fourth, incomplete digital transfers. A screenshot from a Venmo or Zelle account without matching bank statements won't satisfy underwriting. They need to confirm the donor actually had the funds and didn't obtain a personal loan to create the gift. It happens. None of these are malicious. They're just incomplete. And underwriting operates on completeness because if the file gets audited, they have to have done their due diligence to prove the paper trail of the funds. My conservative playbook before any money moves: call your lender, ask for their exact gift fund documentation checklist. Please don't assume. When possible, use a wire transfer cashier's check. They're so much cleaner. They create cleaner trails and eliminate paperwork headaches. Complete the gift letter fully. If the gift letter is $10,000, write $10,000. If it's $12,000, if you get $12,000, then you're going to need a new gift letter for the additional $2,000. The gift letter and the gift funds must match. And if you cannot document the source clearly, you won't be able to use the funds. So adjust strategy early on rather than scrambling at the 11th hour, because nothing creates stress like a funding delay 3 days before closing, only to find funds cannot be used because they cannot be sourced. That will kill your deal. If this clarified how gift funds for a mortgage actually work, please subscribe. I'm building a full underwriting syllabus here. Income, assets, credit logic, so you understand how lenders think before they evaluate you. And tell me in the comments which loan type you're using, FHA, conventional, VA, or USDA. That helps me decide what to break down next. Because approval isn't about luck, it's about preparation. You can't play the game if you don't know the rules. And I'll see you in the next video.